All right, so everyone has an opinion on why small caps have been such horrendous underperformers, but nobody likes them still. My next guest highlights the issues and potential opportunity when he asks in a tweet, are small caps stocks set for a comeback? I want to bring in now Kobeissi, letter editor-in-chief Adam Kobeissi. And Adam, I want you to help us unpack your tweet right here because this is a good one. It caught my attention. Just then, Russell 2000 relative to the S&P 500 just posted its worst first half of the year in history. The Russell 2000 gained just 1.4% versus 14.5%. This is the third straight year of relative underperformance. You also go on to mention that over the last 45 years, such bad streaks have only occurred in 1997 and 1999. So as a result, small caps are the cheapest relative to large cap in 23 years. And of course, you finish off the tweet, are small cap stocks set for a comeback? Guess what my first question to you is, are they?
Yeah, so we kind of wanted to gauge some community sentiment out there, but I think our view remains that higher interest rates are just kind of bogging down these small cap companies, as well as just economic uncertainty right now. In a market where, I mean, we've talked about it so many times, where the Magnificent Seven is just controlling 30% plus of the S&P 500, investors are kind of flocking into these same few names, forgetting about the smaller ones, and not wanting to take on risk with these companies that are, in many cases, struggling from a balance sheet perspective, especially as higher for longer interest rates remain.
Right.
But I think once you start having more certainty about the trajectory of rate cuts, which we don't have right now, that would be the time to start nibbling at these small cap stocks. But for now, in the second half, I don't think that we see small caps start to outperform the S&P 500 anytime soon.
Right. And I get what you're saying. There's no need to jump the gun, but we could see again, the last time this was happening in the late 90s, it was followed by a few years of really strong performance. But again, no need to jump the gun. But the other side of this, of course, would be the S&P 500. Now, you look at that chart. It's near overbought RSI readings right now. Also, at the bottom part of this chart, we can see that the rate of change is starting to really slow. I know you're still bullish. When would you consider cashing in there?
Yeah, I mean, we just continue to raise our target kind of gradually. I think last time I was on, we were calling for 5,500. We actually got there, and now we're calling for 5,600. Kind of just keep raising our target with the trend. Higher lows are forming along with higher highs. And until that trend breaks from a technical viewpoint, I don't really think that we see any major sell-off anytime soon, right. Especially because we've had every reason to sell and we haven't. And what's also interesting is during these periods of severe overbought technical conditions, if you look at the RSI, you look at the Bollinger Bands, typically those would lead to a 5 or 10% pullback in the S&P 500. What's happening is once we get very overbought, we're actually just trading in this range-bound chop like we've seen. We've been in a 50-point range for the last week plus. And technicals come down, and then we make that next move higher. So I think that's just that slow grind higher is just going to continue into year end.
Yeah, great point. We consolidate those gains long enough just to get a little relief, and then it's buy the dip again. So I saw where you were bearish on bonds, gold, and West Texas Intermediate oil. The last one surprised me because oil made a nice move through, I think, the 50 or 200-day moving average. I looked at the chart. Looks like clear selling to 90, but you don't like oil anymore.
Yeah, I think a lot of what our view is right now is that market expectations have become too dovish. There's now 2 interest rate cuts being predicted for 2024 with a possibility of a third, a rising 20% chance of a third. I think the dollar is going to keep rising, pressuring all 3 of those assets. And on the oil front, I think also a lot of the geopolitical tensions have been priced in. You have a lot of demand optimism also priced in. And I think there is room for disappointment on multiple fronts with crude oil. So I just think equity markets are kind of siloed right now and that they will just keep pushing higher. But I think commodities have a lot more exposure to a stronger dollar. The U.S. dollar index is now crossing 106, approaching 107. I think that commodities are due for some downside over the near term.
All right, Adam. Hey, good stuff, man. Glad you could share it with us. Thank you very much.
Thanks, Charles. Thanks for having me.